Hi everyone, welcome to another session on accounting equation. This is our fourth session in this series. In session number 1, I had covered the accounting equation concept, so the whole concept was explained over there. In session number 2, that is lesson 2, a simple transaction was taken and an accounting equation was written for that. And in lesson number 3 or session 3, I had written accounting equation for simple transaction which were on cash. So this is lesson number 4. Here we'll be writing accounting equation for cash and credit, both the transactions. So what would you learn in today's session? Well, in this session you will learn to read the transactions and identify the two accounts involved. What to debit and what to credit would be covered when we are doing the accounting rules. So right now we are just looking at reading the transaction and finding out the two accounts that are involved in it. And then we'll be writing accounting equation after we have identified the two accounts involved. So these are the 5 transactions for which we are going to be writing accounting equation. If you want, you can make a note of these transactions and write these equations after you have watched the videos. Or if you've already seen my previous videos and you would want to write the equation first and then see if it is correct, you can do that. You can pause the video here and write the transactions. So let's have a look at the first transaction. The transaction is John commenced business with cash and the amount is 100,000 or 1 lakh. Say this is John, he has started the business, and when the owner is going to invest into his business, it is referred as capital. So which are the two accounts involved over here? So the first one is cash and the second is capital. So John commenced business with cash, 100,000. So how did you get this money? So it is capital which has come into the business as cash. So let's have a look at the accounting equation. So when you're writing an accounting equation, you need to create a table like this. So you have one column for assets, one for capital, and one for liabilities. And in the first row, you will write the accounting equation, which is assets is equal to capital plus liabilities. Now here, cash has come into the business and cash is an asset. It is a resource for the business. Therefore, cash will come under assets and this cash is capital which the owner has invested in the business. So under assets, you will write cash, which is 100,000, and under capital, you would write 100,000. So your one side, which is your left hand side, is going to be equal to the right hand side. Let's quickly summarize the accounting equation. Assets has cash 100,000, which is equal to capital, which is 100,000, plus liabilities, which is 0 or nil at this point of time. So let's read the second transaction. Now the second transaction is purchased inventory worth 20,000 on credit. So inventory is coming into the business. Inventory is what? The stuff that the business is going to sell and generate revenue. So here the person is buying inventory and he or the business is buying inventory on credit. So it's kind of a borrowing or a loan. So what are the two accounts that are involved in this transaction? So the first is going to be inventory and the second one is going to be, now here it is on credit. So the second one is going to be trade payables. Trade payables is also known as creditors. So if you're doing IGCSE or A levels, the term that you're going to use is going to be trade payables. And if you're doing an Indian board, then the term you're going to use is going to be creditors. I have already done a video on this. If you would want to watch that, I would provide a link of that in the description box below. Now let's have a look at our accounting equation. For each and every transaction, you need to create this table again. Here, this is how it is going to be done. So inventory is an asset. So under assets, I need to add a column over here. So my accounting equation is under assets, now I have cash and inventory, and then I have capital, and under liabilities, I'm writing trade payables, or you can write creditors. What is trade payable? This is the person from whom we buy inventory on credit, or from whom the business has bought inventory on credit. It is trade payables if it is IGCSE or A levels, and if you're doing an Indian board, you'll have to use the term creditors. So let's summarize the accounting equation. Under assets, I have cash, which is 100,000. Then I have inventory, which is 20,000. So the total of my assets is 120,000. And under capital, I have 100,000. And my liabilities are 20,000. So my left hand side is 120,000, which is equal to my right hand side, which is also 120,000. So let's move on to the third transaction. The third transaction is purchased machinery worth 20,000 in cash. So now the business has bought machinery and they have bought it in cash. So what are the two accounts involved over here? So first is what is coming into the business. It is machinery which is coming into the business. So that is going to be one account. So the second account involved over here is cash. So the business has bought machinery and it has paid by cash. Let's have a look at the accounting equation. So this is how your accounting equation is going to look like. Now machinery is an asset. What are assets? These are resources of the business which are used for the purpose of generating revenue. So machinery is an asset. So here if you see, you'll have to add one column over here under assets. So you'll have to draw this table again for this transaction, and under assets now you have three columns, then you have capital, and then you have liabilities. So inventory is same 20,000 as the previous transaction. Machinery has come in over here, so machinery has gone up. And how did you pay for this machinery? You paid by cash. So your cash has gone down to 80,000. Why? Because you paid for the machinery. So assets has cash $80,000, inventory $20,000, and machinery $20,000. So the total of this side is 120,000, and that is equal to capital, which is 100,000, and your trade payables. Again, your left hand side is 120,000 and your right hand side is 120,000. Therefore, your left hand side is equal to your right hand side. So let's move on to the next transaction. And the transaction is purchased equipment worth 15,000 in cash. Now, equipment is also an asset for the business. It is a resource that is going to be used for the purpose of generating revenue. And here, the business has bought equipment and it has paid by cash. So what are the two accounts involved in this transaction? So the first account is equipment. What did the business buy? It bought equipment. So that is one account. So how did you pay for this equipment? So the second account here is cash. Now let's have a look at the accounting equation. So again, you will be drawing this table for this transaction. So now here one more asset has come into the business. So the under asset, you need to put one more column over here. So now the business has four assets: cash, inventory, machinery, and equipment. And under capital, it is capital. And under liabilities, it is trade payables. So assets are cash 65,000. How did my cash become 65,000? Well, we bought equipment which was of 15,000. So it was 80,000 in the previous transaction. But when you bought equipment and you paid for that, so this became 65,000. So assets are cash 65,000, which has gone down. Inventory 20,000. Machinery 20,000. Equipment, which is 15,000, this has gone up. Now the total of this is 120,000. Now this is equal to capital, which is 100,000, plus trade payable, which is 20,000. So your left hand side is still 120,000 and your right hand side is 120,000. So here you can see that the total might be same, but the composition of assets is changing with each transaction. Now let's move on to the last transaction. And the last transaction is paid trade payables 5,000. Now what is trade payables? Trade payables is the person from whom inventory is bought on credit. Another name for trade payables is creditors. So one account over here is trade payables, and you're paying this money in cash. So the second account is going to be cash. Now let's have a look at the accounting equation. So this is your accounting equation. So under assets, you have cash, inventory, machinery and equipment, and the total of this is equal to capital plus liabilities, which is trade payables. So here you would see that your trade payables was 20,000, but now it is only 15,000. And why it is 15,000? Because 5,000 has already been paid. So trade payables has reduced to 15,000, and at the same time the cash has also reduced by 5,000. So my accounting equation is cash 60,000, which has gone down by 5,000, inventory 20,000, machinery 20,000, equipment 15,000. Now the total of this is equal to capital, which is 100,000, and trade payables, which is 15,000. So this is 115,000 and this is also 115,000. I hope you have understood all the transactions. In case there is any doubt or any question, you can post them in the comment section below. If you found this video useful, then give it a thumbs up and subscribe to our channel. And press the bell button to stay notified about all our future videos. Till the next video, bye-bye.